So Trump just signed the One Big Beautiful Bill into law on July 4th, 2025. And if you're a small business owner, this could literally save you tens of thousands of dollars in taxes this year. I'm talking about massive changes to business deductions that most people have no idea even exist yet. But here's the thing, and this is important. These aren't just minor tweaks to the tax code. We're looking at permanent changes to how small businesses can write off everything from equipment purchases to research and development expenses. And if you don't know about these changes, you could literally be leaving free money on the table that you're actually entitled to. Because I've been preparing tax returns for small business clients for many years. And I can tell you that after every major tax law change, I usually find 1 to 2 new qualified expenses that my clients had no idea they could write off. And that's exactly what's happening right now with the One Big Beautiful Bill. That's why today I'm going to reveal my 3-step strategy that combines these new provisions so you don't miss out on massive tax savings. But before I get started, if we haven't met yet, I'm Sean's clone, a tax professional who personally researches and writes every script you see on this channel. And while Sean is helping people save on taxes, I'm here to share his knowledge with you. But if you have any questions, the real Sean reads every single comment and tries to respond to most. Let's jump in with chapter number 1, the new foundation, permanent QBI deduction. This is huge. The 20% qualified business income deduction is now permanent with enhanced phase-out thresholds. Now, what is QBI? The QBI deduction allows pass-through business owners, that's LLCs, S corporations, sole proprietors, and partnerships, to deduct up to 20% of their qualified business income from their personal tax return. It's like getting a 20% discount on your business profits. The 20% deduction for pass-through income is now permanent, with phase-out threshold jumping to $75,000 for single filers and $150,000 for joint returns, up from $50,000 and $100,000. But here's where this gets really powerful. This permanent deduction now works in combination with the other provisions to create what I call the tax stacking effect. Keep this in mind because it's going to multiply as we go through chapter 2. Bonus depreciation is back at 100% permanently. As a tax professional, this gets me really excited because I know how much of a significant impact this will have on small businesses and investors. So what is bonus depreciation? Bonus depreciation allows you to immediately deduct a percentage of qualifying business property in the year you buy it, instead of spreading the deduction over several years. Think of it as an instant write-off for equipment, vehicles, and other business assets. Assets acquired and placed in service on or after January 19th, 2025 once again qualify for full expensing. Property installed earlier in the year still follows the old 40% and 20% phase down. Let's say you're a manufacturing business planning to buy $1 million in machinery in 2026. Under the old phase out schedule, you would only get 20% bonus depreciation, meaning you could immediately deduct $200,000 and the remaining $800,000 would be depreciated over several years. In the 24% tax bracket, that's $48,000 in immediate tax savings. Now, that same $1 million purchase gets 100% bonus depreciation permanently. That's $1 million in immediate deductions, which saves you $240,000 in taxes. If you're in the 24% bracket, that's an extra $192,000 staying in your pocket. But here's where the stacking effect starts to work its magic. This $1 million deduction also reduces your taxable income, which means you get even more benefit from that QBI deduction we just talked about. This brings me to the next point, which multiplies the equipment benefits even further. Chapter 3, Section 179, Limit Doubles. Now here's what most accountants won't tell you about equipment purchases. While bonus depreciation handles the big purchases, Section 179 is perfect for smaller equipment purchases, and these limits just double. Now what is Section 179? Well, it is like bonus depreciation's smaller sibling. It lets you immediately expense equipment purchases up to a certain dollar limit, but it's specifically designed for small and medium-sized businesses with caps and phase-outs. Small businesses can now expense up to $2.5 million of qualifying property immediately, with a phase-out beginning at $4 million of total purchases. Both amounts index for inflation. But wait, there's a strategic advantage here. A dental practice purchasing $2 million of gear can deduct it all in year one. saving $480,000 instead of depreciating gradually over several years. The beauty of having both Section 179 and permanent bonus depreciation is the flexibility it gives you. You can choose which method works better for your specific tax situation each year. This flexibility becomes crucial when you're implementing that three-step strategy I mentioned earlier. The next chapter focuses on something that affects every business that borrows money to grow. Chapter 4, Interest Deduction Limit Returns to EBITDA. Here's the thing that most business owners don't realize about equipment financing. This next change might sound technical, but it's going to save profitable businesses serious money. But what is the business interest limitation? This rule limits how much interest expense you can deduct based on your business earnings. Think of it as the IRS saying you can only deduct interest up to 30% of your adjusted earnings. And the key word is adjusted. Starting in tax years beginning 2025, the 30% cap is applied to EBITDA, not EBIT, restoring depreciation and amortization add-backs. Since 2022, businesses could only deduct interest up to 30% of their EBIT. That's earnings before interest and taxes. So let's say your construction company had $1 million in EBIT and $400,000 in interest expenses from equipment loans. You could only deduct $300,000 of that interest, with the remaining $100,000 carried forward. Starting in 2025, we're back to the EBITDA calculation. Using the same construction company example, if they had $1 million in EBIT but $300,000 in depreciation and amortization, their EBITDA would be $1.3 million. Now they can deduct $390,000 instead of $300,000. That extra $90,000 deduction saves them about $21,600 in taxes. Here's why this matters for the stacking strategy. When you buy equipment using financing, you get the immediate equipment deduction and you can deduct more of the interest expense. Moving on to something that affects any business investing in innovation. Chapter 5, R&D Expensing Revival. You won't believe what just happened to research and development expenses. This next change is huge for any business that invests in artificial intelligence, product development, or improving their processes. And what are R&D expenses? Research and development expenses include costs for developing new products, improving existing products, or creating new processes. This covers everything from software development to product testing to market research, basically any cost related to innovation. Domestic research expenses are again fully deductible for tax years, beginning after December 31st, 2024. Businesses with average receipts below $31 million may retroactively expense costs capitalized in 2022 through 2024. Let's use a software company that spent $500,000 developing a new application in 2024. Under the amortization rules that started in 2022, they could only deduct $100,000 per year for 5 years. In the 24% tax bracket, that's $24,000 in tax savings per year. But they had to wait 5 years to get the full benefit. Starting in 2025, that same software company can deduct the entire $500,000 in R&D expenses immediately. That's $120,000 in tax savings in year one instead of spreading it out over 5 years. But here's the real kicker. If you've been stuck amortizing R&D expenses since 2022, you might be able to get a massive refund. This is where the stacking strategy becomes really powerful. Businesses that invest in both equipment and research and development can now potentially deduct both immediately. This brings me to that mystery provision I promised earlier. Chapter 6, QSBS Supercharged. Here's that provision I mentioned in the introduction that most people miss. The enhanced qualified small business stock benefits could literally save you millions in taxes when you sell your business. Now, what is QSBS? Qualified small business stock is a special tax provision that allows you to exclude capital gains from federal taxes when you sell qualifying small business stock. It's designed to reward entrepreneurs and early investors in small businesses. The new law includes 3 major enhancements: $15 million gain exclusion cap, company gross asset ceiling raised to $75 million, and tiered gain exclusion. 50% after 3 years, 75% after 4, 100% after 5. Here's why this is so powerful. Start a tech company and after 3 years, get an acquisition offer worth $5 million in capital gains. Under the new rules, you can exclude 50% of that gain after just 3 years. That's $2.5 million tax-free. This connects back to all the deduction strategies we've covered because the more you reduce current taxes, the more capital you have to reinvest and grow your business to QSBS qualifying levels. The next chapter takes us into advanced wealth building strategies. Chapter 7, Opportunity Zones 2.0. Here's something that will completely change how you think about capital gains. The Opportunity Zones incentive is now permanent. But what are opportunity zones? Opportunity zones are economically distressed communities where you can invest capital gains and receive significant tax benefits. It's the government's way of encouraging investment in underserved areas while giving you tax advantages. Investors can defer capital gains for up to 5 years and still wipe out post-10-year appreciation tax-free. Every decade, states may propose new zones. Here's the strategy that wealthy investors use. Sell equipment with depreciation recapture, defer those taxes by investing in opportunity zones within 180 days, and simultaneously buy new equipment with the enhanced deduction benefits. The permanent nature makes this a viable long-term wealth building strategy. This brings me to our final point about generational wealth transfer. Chapter 8, Estate and Gift Exemption Climbs. Here's the ultimate wealth building secret. The lifetime exemption jumps to $15 million per person, $30 million per married couple, beginning 2026. So what are estate and gift tax exemptions? These exemptions determine how much wealth you can transfer to your heirs without paying federal estate or gift taxes. Think of it as your tax-free wealth transfer allowance that protects family businesses and generational wealth. Build a $20 million business using all these tax strategies, and you can transfer up to $30 million to your children without estate or gift tax consequences. This is the ultimate outcome of the stacking strategy. Use current tax benefits to build wealth faster, then pass it to the next generation tax-free. Bringing me to Chapter 9, the 3-step stacking strategy revealed. Now, here's that 3-step stacking strategy I've been promising throughout this video. Step 1, maximize current deductions. Use the permanent QBI deduction, 100% bonus depreciation, enhanced Section 179 limits, and R&D expensing to reduce your current tax liability as much as possible. Step 2, reinvest tax savings. Take the money you save from Step 1 and reinvest it into more equipment, R&D, or business growth, creating even more deductions in a compounding cycle. Step 3, build long-term wealth. Use the enhanced QSBS benefits and permanent opportunity zones to convert your business success into tax-free gains, then leverage the higher estate tax exemptions to pass wealth to the next generation. All right, so we've covered the 8 major changes from the One Big Beautiful Bill Act that will provide more tax write-offs for small businesses. If you're a small business owner, implementing just 3 or 4 of these strategies could save you tens of thousands of dollars in taxes while helping you build generational wealth. The key is understanding which ones apply to your specific situation and implementing them correctly. If you need help, make sure you click the first link in the description below or comment any questions you have. And if you're looking for a video that explains the big, beautiful tax bill beyond what provisions apply to business owners, then make sure you click the video that's on the screen now, and I'll see you over there.